Welcome to Breaking News to Trading Moves.
Great to be here.
Today we're looking at a very specific collision in the markets. It's a bit of an unusual pairing.
It is.
We are observing a situation where volatility in luxury stocks is crashing right into market nerves surrounding artificial intelligence.
Yeah, on the surface, they seem like two totally different worlds. One's about high fashion, handbags, prestige goods.
Right, very tangible thing.
And the other is about, algorithms, data centers, the future of technology. But they're becoming connected in a really direct way when it comes to the market.
And that's what we need to get into. This isn't really a story about whether a new handbag is a hit or not.
No, not at all. It's not about fashion trends or supply chains, which is what we usually talk about with these names. This is purely a story about market positioning and volatility.
Exactly. So let's get into the mechanics here, because it's not just about, whether people like a certain brand. The data shows there are two distinct forces driving these big price swings.
That's right. Two main drivers.
Let's start with the first one. It seems to be all about the big money, the institutional players. I'm talking about hedge fund positioning.
This is a critical piece of the puzzle. It's really the starting point. The data we're seeing shows that hedge funds are leaning heavily into short positions.
So they're betting against these companies.
They're betting against them, or, and this is an important distinction, they're setting up for what we call fast turn trades.
Okay, fast turn. Break that down for us. What does that mean in practice?
It means they are not long-term investors here. They are not buying a piece of a brand because they believe in its 20-year vision.
They don't care about the next collection.
They care about the next 3 days. These trades are specifically clustered around earnings reports. That's the catalyst they're watching.
So they're getting in right before the numbers come out and planning to get out right after.
Precisely. They are positioning for a quick, sharp move. And because so many funds are doing the same thing, crowding into these short positions or these quick turnaround option strategies, it creates a kind of coiled spring effect.
A coiled spring, meaning any little nudge can cause a massive reaction.
Exactly. The stock is primed to move dramatically on any news, good or bad, because the positioning is already so extreme.
Okay, so that's force number one. The professional traders are all crowded on one side of the boat.
That's a good way to put it.
Now that brings us to the second force, which feels, a bit more psychological. It's being called the AI wealth effect.
And this is the key idea. This is the narrative that ties it all together. It's a newer phenomenon, but it makes a lot of sense when you think it through.
So what is it?
The concept is that market nerves, specifically what we're calling AI jitters, spill over into high-end spending expectations.
AI jitters.
Yeah.
You mean when the big AI-related tech stocks have a bad day or a bad week?
Exactly. When those market leaders, the ones that have driven so much of the market's gains, start to look shaky. Think about who owns a large amount of the equity in those names.
It's going to be wealthy consumers, people with substantial investment portfolios.
Correct. So when the broader market gets jumpy, particularly around those AI leaders that have been the cornerstone of portfolio growth for the last couple of years, it has a direct impact on the portfolios of those wealthy consumers.
And more than that, it impacts their sentiment, their mood.
That is the core of the mechanism. So even if their bank account balance is still perfectly fine, looking at a volatile portfolio, seeing those big tech names down 5–10%, it just makes them feel less wealthy.
It's a perception issue.
It's entirely a perception issue. But perception drives behavior. It changes how they perceive their own wealth and their financial stability. And when that perception moves, it flows almost immediately through to discretionary spending.
Especially at the highest end.
Especially at the highest end. Luxury demand expectations are the first to get hit. If you feel like your portfolio is on shaky ground because of AI volatility, you might hesitate before buying that new watch or that expensive handbag.
Not that you can't afford it. It's that you suddenly don't feel like you should.
That's it. The feel-like part is everything. So you have the psychological shift in the key consumer base for luxury goods.
And then you combine that hesitation, that shift in sentiment, with the hedge fund positioning we just talked about.
And that's where the explosion happens. You get these amplified, exaggerated moves in the stocks.
How does that work?
Well, the hedge fund positioning exaggerates the reaction to any piece of news. Let's say a luxury company comes out with earnings. The numbers are okay, not great, not terrible, but their guidance is just a little bit cautious.
It's just a hint of doubt.
A hint of doubt. Normally, the stock might drift down a couple of percent, but now you have this AI wealth effect narrative in the background. Traders are already worried that the wealthy consumer is pulling back,
And the hedge funds are already short.
and the hedge funds are already short. So that slightly cautious guidance is seen as confirmation of everyone's biggest fears. The shorts press their bets, new sellers come in, and a 2% move becomes a 10% move down.
Wow. Okay. So that really helps explain why the market is paying so much attention to this. It's about this concept of crowded positioning.
Crowded positioning is one of the most dangerous things in any sector, at any time. It means too many people are expecting the same outcome.
And when everyone is on one side.
The exit door is very small. When too many funds are in shorts or these quick, event-driven trades, even small surprises can turn into enormous price moves. The market isn't reacting to fundamentals anymore, it's reacting to the positioning itself.
In the notes we're looking at, we see references to gap moves. Can you explain what that is?
A gap move is a trader's nightmare, or dream, depending on which side you're on. It's a sudden, sharp jump in a stock's price, either up or down, where no trading actually occurs in between.
So it just teleports to a new price.
That's a great way to think about it. It might close at $50 one day and open at $40 the next morning, with no trades at $49, $48, or any price in between. It just snaps to a new level.
And that's a major risk when positioning is so one-sided.
It's the primary risk. If you're short and the company reports unexpectedly good news, the stock can gap up and your losses can be much, much larger than you anticipated. The reverse is also true.
But, on the flip side of that risk, there are opportunities mentioned here too. Things like mean reversion, options premium, and pair trades.
Right. For every risk, there's a potential opportunity for someone else. Mean reversion is a big one here.
What's the thinking there?
Mean reversion is the theory that prices and returns eventually move back toward their average. So if a luxury stock gaps down 15% purely because of this emotional reaction and crowded positioning.
But the company itself is still solid.
Exactly. If the fundamentals haven't really changed, a trader might bet that the emotional selling was overdone and that the price will eventually bounce back or revert to the mean. That's a trading opportunity.
And what about options premium?
Options premium is just the price you pay to buy an option contract. When volatility is high, when prices are swinging all over the place.
The demand for insurance goes up.
Precisely. The demand for protection or for speculative bets goes way up. That drives up the price or the premium of those options. So traders who sell options can collect that inflated premium.
And finally, pair trades.
A pair trade is a strategy where you try to neutralize your overall market risk. For example, you might bet on one luxury company that you think is strong and bet against, or short another one in the same sector that you think is weak.
So you don't care if the whole sector goes up or down.
You're just betting on the relative performance. You're betting that your chosen winner will do better than your chosen loser. It's a way to play these dynamics without betting on the direction of the entire market.
And it's important to note the specific sector we're focused on here. This is about U.S.-listed consumer discretionary stocks.
That's the main arena, yes. That's where this battle between the AI, wealth effect sentiment, and hedge fund positioning is really playing out most clearly.
So for you, listening to this, trying to make sense of it all,
Yeah.
how should you think about it? What's the guidance here for watching this unfold?
The number one thing is to watch the earnings windows very, very closely.
The actual report dates.
The dates, the calls, the press releases, but most importantly, the tone of the corporate guidance. When positioning is this crowded, the actual numbers from last quarter almost matter less than what the CEO says about the next quarter.
Because everyone is just listening for a reason to sell or a reason to cover their short position.
Exactly. It's a game of chicken. If the company's management sounds even slightly cautious or uncertain, the crowd reacts instantly and sells. But if they come out and sound incredibly confident, it can trigger a massive short squeeze.
A short squeeze being when the short sellers are forced to buy back shares to close their positions, which drives the price even higher.
Correct. A very violent move upwards. So the language, the tone, it all matters immensely in this kind of environment.
And we also have to talk about volatility as a driver in and of itself. It's not just a result, it's a cause too.
That's a great point. Volatility feeds on itself. As we mentioned, volatility lifts options activity. When prices are swinging wildly, more and more people are drawn to the options market to protect their portfolios or to speculate.
Which means more business for the exchanges.
More business for the exchanges, more work for the market makers, and it just keeps the whole cycle going. The volatility itself becomes a reason for more trading.
And then there's this concept of de-risking. What is that?
De-risking is the sequence of events that investors need to understand. Let's imagine those AI jitters we talked about intensify. Let's say the big tech names that have led the market actually start a real correction, down 10 or 15%.
So the market goes into risk-off mode.
Exactly. When that happens, portfolio managers have to sell something to reduce their overall exposure. They have to de-risk. And the first place they almost always look is consumer discretionary.
Why discretionary? Why not, healthcare or utilities?
Because it's the easiest thing to justify cutting. In a downturn, people still need medicine, they still need electricity. Those are staples. But you don't need a luxury item. It's, by definition, discretionary.
It's a want, not a need.
It's a want, not a need. So the market targets the premium and aspirational categories for this de-risking. It's the path of least resistance for a portfolio manager who needs to sell something and raise cash quickly.
Okay, that makes a lot of sense. It's the first thing to go.
First thing to go.
So let's use that as a bridge to talk about the specific winners and losers in this scenario. Because it's not just about the luxury brands themselves, right? There's a whole ecosystem at play here.
A very broad ecosystem.
The first category of winners is what we might call the toll collectors, the market's infrastructure.
I like that term, toll collectors. It's perfect. This is the underlying infrastructure of the market itself. And the logic is very straightforward.
More traffic on the highway means more tolls collected.
Simple as that. More volatility, as we've been saying, typically means higher options volume. It also means increased hedging demand from all sorts of players.
And all that activity supports trading revenue for the exchanges and the market makers.
Right. They get paid when people trade. They don't necessarily care if the market goes up or down. In fact, a volatile, choppy market is often much better for their business than a market that just grinds slowly higher.
They want movement.
They thrive on movement and transactions. They are the house, and the house gets a small piece of every single bet.
Okay, let's look at the specific tickers that are mentioned here as potential beneficiaries. First up, we have CBOE, that's Cboe Global Markets, ticker CBOE.
CBOE is the classic beneficiary in a situation like this. They are, in many ways, the home of volatility. They operate the Cboe Volatility Index, the VIX, which is the market's fear gauge.
Right.
When volatility spikes, trading in VIX futures and options explodes. But beyond that, they run a massive options exchange. So when overall options volume in the market picks up because people are hedging or speculating on these luxury names, CBOE sees a direct increase in its transaction revenue.
More contracts being traded means more fees for them.
Exactly. They are a direct play on rising market activity and volatility.
Then we have NASDAQ, ticker NDAQ.
NASDAQ is a slightly broader play. They benefit from general trading activity, of course, through their exchanges. When the market is busy and volumes are high, their trade execution revenues go up.
It's more than just trading, right?
It is.
Yeah.
NASDAQ also has a large business in, market data, analytics, and listings. In a volatile environment, the demand for real-time data and sophisticated analytics can increase. And while listing dynamics are a longer-term story, high market activity generally keeps the NASDAQ brand front and center.
So they're a beneficiary of a busy, active market.
A very direct one.
And the third one in this toll collector group is ICE, Intercontinental Exchange, ticker ICE.
ICE is another huge player in the market infrastructure space. You might know them as the owner of the New York Stock Exchange.
Right.
So, like NASDAQ, they benefit from equity trading volumes. But ICEs is also massive in commodities and derivatives. They benefit from broad hedging demand across asset classes. When funds need to hedge their portfolios because of this kind of stock-specific volatility spilling over, exchanges like ICE are the primary facilitators. They provide the tools to manage that risk.
So CBOE, NDAQ, and ICE, all benefiting from the churn and activity itself.
They are the picks and shovels in this gold rush of volatility.
Okay, moving on to our second category of winners, retail trading and brokerage activity.
This is the platform side of the equation. This is about who is facilitating the trades for the individual investor.
And the logic here seems to be that when headlines are loud and price swings are big, retail participation tends to rise.
It's a pattern we see time and time again. A quiet market often leads to retail disengagement. But when the news is loud, when a stock is down 20% in a week, retail investors get active.
They jump in.
They jump in. They might be trying to buy the dip, thinking it's a bargain. They might be panic selling what they already own. Or increasingly, they might be using options to try and hedge their own small portfolios or make a speculative bet.
So for the brokers, all this activity serves as a tailwind. It depends on activity.
Yes, it's an activity-dependent tailwind. More trades can mean more engagement, potentially more margin usage, and in some business models, more payment for order flow or direct fees. It keeps users on the platform.
Let's talk tickers. The first one is Charles Schwab, ticker SCHW.
Schwab is, a massive platform. They are a behemoth in brokerage and asset management world.
So how does this environment help them?
For Schwab, it's about engagement across their huge user base. Increased account activity and higher trade volumes are a net positive, but it's also about asset flows. In a nervous market, you might see a flight to safety, where investors move cash into money market funds, which Schwab also benefits from. So it's a story of both increased trading and a potential reallocation of assets on their platform.
And the second name here is Robinhood Markets, ticker HOOD.
Robinhood is, in some ways, the polar opposite of Schwab, but they benefit for related reasons. Robinhood's platform is very sensitive to retail engagement driven by headlines.
They're known for that.
They are. Their user base tends to be very active when market headlines are loud and specific stocks are making big, fast moves. Their revenue model is more directly tied to transaction volumes, especially in options. So a period of high volatility in popular sectors can be a direct driver of activity and revenue for Robinhood.
Okay, so that covers the platforms. Now, let's talk about where the actual money goes if it's not going into luxury goods. This is our third category of winners, the value discount consumer rotation plays.
This is the classic rotation trade. It's a fundamental concept in sector analysis. If investors become cautious on premium discretionary spending,
If they believe that wealthy consumer is pulling back,
then that spending potential doesn't just, evaporate into thin air. It doesn't vanish. It often moves down the value ladder.
people still have to buy things.
They still have to buy things. But instead of buying the $10 organic kale, they buy the $3 regular kale. Instead of the designer jeans, they buy the store brand jeans. It's a trade down effect.
And so the money rotates towards value-focused retailers.
Exactly. You look for businesses with what we call resilient demand profiles. These are companies that tend to perform well or at least hold up better than others, even when economic sentiment is down.
Because their value proposition becomes more attractive.
It becomes much more attractive. When people are feeling cautious, value is king.
The first and maybe most obvious ticker here is Walmart, ticker WMT.
Walmart is the primary destination for a value-focused rotation. It's almost the definition of it. If you're worried about your investment portfolio or the economy in general, you're probably not browsing a high-end boutique. You're going to Walmart for groceries and essentials.
And it's not just about low prices, is it?
No, it's about the breadth of their offerings. They are a one-stop shop. And they've also been quite successful at attracting higher-income shoppers who are looking for value in groceries, which can make them resilient even when it's the wealthy who are cutting back.
So they capture spending from all angles in an environment like this.
They are uniquely positioned to do so.
The second name mentioned is Costco Wholesale, ticker COST.
Costco. It's a fascinating case. It's a great example of resilient demand.
How so? Because it's not the cheapest, right? You have the membership fee.
You have the membership fee and you're buying in bulk. But it benefits from this shift away from premium discretionary in a powerful way. The core value proposition of Costco is high quality at a great price.
The treasure hunt aspect.
There's the treasure hunt, but there's also the loyalty. The membership model creates an incredibly loyal customer base. When those customers are looking to cut back elsewhere, they often lean more heavily on Costco. They'll cancel a dinner out, but stock up on steaks from Costco to cook at home.
So it's a trade down, but it feels like a smart choice, not a sacrifice.
That's the magic of their model. It offers value, but it still has a loyal, often affluent customer base that sticks with it, even when they're cutting back on true luxury items.
All right, so we have our winners, the toll collectors, the platforms, and the value retailers. Now we have to look at the other side of the coin, the losers.
The ones directly in the line of fire.
Who gets hit the hardest? The first group is pretty intuitive. Premium and aspirational fashion, specifically the U.S.-listed names.
The mechanism here is that risk-off sentiment we discussed earlier. If that AI-linked market wobble really takes hold, investors immediately mark down their expectations for demand for premium goods.
They just assume people will stop buying them.
They assume it instantly. And they're not necessarily wrong to do so. The market is a discounting machine. It looks forward. They specifically assume that the aspirational shopper is the first to go.
Define the aspirational shopper for us.
The aspirational shopper is someone who is maybe not traditionally wealthy, but reaches a bit to buy that expensive bag or those shoes. It's a status purchase for them. They're stretching their budget.
And when they feel nervous.
That's the first thing they cut. It's an easy cut to make. So these companies have a very high sensitivity to that affluent and, crucially, that aspirational consumers' spending habits.
And that makes them the first to be punished by the market when sentiment turns sour.
It does. The market is forward-looking. It will sell these names before the sales numbers actually show a drop, just on the expectation of a drop. The stock price reflects the fear before it reflects the reality.
Let's talk about the tickers mentioned. First is Tapestry, ticker TPR.
Tapestry is the parent company of brands like Coach, Kate Spade, and Stuart Weitzman.
So accessible luxury.
That's the perfect term for it, accessible luxury. Their portfolio of brands is squarely aimed at that premium, but not ultra-high-end consumer. They are very exposed to this specific tier, the aspirational buyer. So when risk-off sentiment hits, Tapestry stock is often one of the first to feel the pressure.
And the other name here is Capri Holdings, ticker CPRIR.
Capri is in a very similar boat. They own Michael Kors, Versace, and Jimmy Choo.
So a bit of a mix from accessible to higher end.
A bit of a mix, but Michael Kors is a huge part of their business, and it plays in that same accessible luxury space. Capri faces the exact same headwinds. When analysts downgrade their demand expectations, the stock gets hit hard because its valuation is so closely tied to delivering growth in that premium segment.
Okay, so that's fashion.
Yeah.
Next on the losers list, we have the beauty and prestige cosmetics sector.
Now, this one requires a little bit of nuance. It's not as straightforward.
Because usually you hear about the lipstick effect, right?
Exactly. The lipstick effect is the old theory that in a recession, women will still buy small-ticket luxury items like a nice lipstick, even if they can't afford a new coat. It's an affordable indulgence.
So beauty is supposed to be resilient.
It's supposed to be. But the data we're looking at here suggests that prestige beauty is still discretionary at the margin.
What do you mean at the margin?
It means while a $10 lipstick might be resilient, a $150 jar of face cream or a $200 bottle of perfume is not. That's a discretionary purchase.
It's not a necessity.
It is not a necessity. So if the market narrative really shifts to this wealth effect risk, the expectations for these high-end beauty names can soften pretty quickly.
And the rising volatility in the market impacts them.
It does. They get swept up in the broader discretionary sell-off. When portfolio managers are told to sell discretionary, they often don't distinguish between a handbag company and a prestige cosmetics company. They just sell the whole group.
The tickers here start with Estee Lauder, ticker EL.
Estee Lauder is the undisputed giant in prestige beauty. They own a huge portfolio of iconic brands like La Mer, Clinique, MAC.
So they're a bellwether for the sector.
A complete bellwether. When there are concerns about the wealthy feeling poorer or aspirational consumers in places like China pulling back, expectations for Estee Lauder's growth can soften considerably. They are very exposed to that high-end global consumer.
And the other name is Coty, ticker COTY.
Coty is another major player, particularly strong in fragrances with brands like Gucci, Burberry, and Hugo Boss, and also in cosmetics.
And they face the same issues.
They do. As a discretionary name, they're vulnerable to this narrative. If the market thinks people are feeling poorer, the first assumption is that they'll buy less perfume and fewer high-end cosmetics. It's a direct hit to the growth story.
Okay, that brings us to our final category of losers, department stores and premium multi-brand retail.
This category, you could argue, faces the biggest challenge of all. They get hit with a double hit.
A double hit. Explain that.
Yes. So first, they face the same demand uncertainty we've been discussing this whole time. Will people show up to the store? Will they be in a mood to spend?
That's hit number one.
That's hit number one. But secondly, and this is unique to them, they face inventory and markdown risk.
Because they are the ones physically holding all the goods.
Exactly. Tapestry can sell their handbags to the department store and their sale is done. But now the department store is stuck with the stuff. They own the inventory.
And if demand drops,
they're in a tough spot. And that brings us to the crucial concept of pricing power. When consumer sentiment turns negative, the market immediately questions whether these stores can maintain their prices.
Or will they have to start discounting everything just to move it off the shelves?
That's the big fear. And if they have to resort to widespread discounting and markdowns, their profit margins get absolutely crushed.
So it's a threat to both their sales and their profitability.
Correct. That's the double hit.
Let's get to the tickers. First up is Macy's, ticker M.
Macy's is a classic example here. They have a massive physical footprint and carry a huge amount of inventory across many categories. They are very vulnerable to these inventory risks and the subsequent markdown pressures. If they guess wrong on demand, they have to slash prices to clear out seasonal apparel and goods.
And the market knows that.
The market is acutely aware of that risk.
The other ticker is Nordstrom, ticker JWN.
Nordstrom is a bit different from Macy's. They have a much stronger exposure to the premium and luxury consumer.
So you'd think they'd be more insulated.
In some ways, yes, their core customer is wealthier, but they are not immune. If that high-end consumer pulls back, Nordstrom feels it directly, and the market starts to question their pricing power. The whole Nordstrom brand is built on service and a curated selection of premium goods at full price.
And if they have to start running big sales all the time?
It hurts the brand and it hurts the margins. So the risk for Nordstrom is that a pullback from their core consumer forces them to compete more on price, which is not a game they are structured to win.
So to wrap this all up, let's just recap the main dynamic that we've covered.
Yeah, let's bring it all together. The core story here is about the intersection of two seemingly separate worlds.
Right.
On one hand, you have the world of high tech, specifically AI. Jitters and volatility in those key stocks are affecting the sentiment of the wealthy individuals who own them.
It's that AI wealth effect. It makes them feel less secure, even if you're still rich.
Exactly. And that feeling leads directly to volatility in the luxury sector because investors anticipate a pullback in spending on high-end discretionary goods.
And that volatility, combined with the crowded hedge fund positioning, creates a very specific set of winners and losers across the market.
It really does. It benefits the market's toll collectors, the exchanges like CBOE, NASDAQ, and IC, and the brokerage platforms like Schwab and Robinhood that facilitate all the frantic trading activity.
The money then rotates away from premium goods and toward value.
Which benefits the value retailers,
Yep.
the Walmarts and Costcos of the world, where that consumer spending goes when it's looking for safety and affordability.
But on the other side, it directly hurts the premium fashion brands like Tapestry and Capri, the prestige beauty names like Estee Lauder and Coty.
And of course, the department stores like Macy's and Nordstrom that are left holding the inventory and have to worry about their pricing power.
And as we said right at the start, this is really a story of positioning and sentiment more than anything else.
It truly is. It's about how the market is set up and how the market feels. And in the short term, those two things can be just as powerful, if not more powerful, than the underlying fundamentals of the companies themselves.
Well, before we go, we do need to provide our standard disclaimer. We have to make it clear that this discussion is not financial advice.
That's right. There are absolutely no buy or sell recommendations being made here.
What you've heard today is purely the opinion of the author.
We're just looking at the data, analyzing the market mechanics, and talking about the connections we see.
It's for informational and educational purposes only.
Please do your own research before making any investment decisions.
Thanks for listening to Breaking News to Trading Moves. We'll see you next time.